this. So this will
Yeah,
still be money. And it's legal tender. And some states are now making it. You can pay your taxes in it and all this stuff. So there's a
absolutely.
revolution going on that Andy's
And
talking about.
and that is a big deal.
Robert Kiyosaki always shares financial insights through which we see his perspective and learn a lot about his views regarding any financial or economic point of view. In his thought-provoking discourse, he sheds light on a topic that strikes close to home for many: the risk of losing one's home. He unveils the factors that could potentially lead banks to take your home. Today, I'm about to explain it all to you. Overview of how banks work with borrowed money. Banks play a pivotal role as intermediaries between borrowers and savers, making the wheels of economies turn. To understand this symbiotic relationship, one must know how banks operate with borrowed money, a cornerstone of modern financial systems. At the heart of their operation lies the concept of fractional reserve banking. When you deposit money into a bank, it doesn't simply sit idle.
And it won't be at the taxpayer's expense, which we all knew was a lie. It would be at your dollar's expense or your deposit's expense, in the respect that the money had to be created out of thin air. And we just figured that would mean more inflation. And so all of the banks, regardless of their poor choices, their gambling, if you will, in depositors' assets, and we'll talk about that in a moment, that they'd be bailed out, and that this would just be an ever increasing party of printing and of backstopping the banks. And
Banks utilize a portion of these deposits as reserves, ensuring they have enough funds to meet withdrawal demands from depositors. The rest of the money, known as excess reserves, becomes the foundation for lending and investment activities. This excess forms the basis of the money multiplier effect, a central tenet of modern banking. As banks lend out a fraction of the excess reserves, borrowers utilize these funds for various purposes, stimulating economic activity. In turn, the recipients of these loans deposit the funds back into banks, allowing a fresh cycle of lending and deposit creation. In the middle of this financial symphony, Robert Kiyosaki gives an intriguing warning. Insights from Robert Kiyosaki hint at a systematic weakness that may be related to the fundamentals of how banks manage their borrowing. His statements give a distinct perspective that warrants thought, bringing our attention to a risk component intertwined with this financial environment. This intricate cycle is intertwined with risk management. Banks carefully assess borrowers' creditworthiness and the potential returns on investment before extending loans. These loans, for businesses, mortgages, or personal needs, often bear interest, generating revenue for the bank. This revenue covers operational costs and forms the basis for profits. Banks also foster liquidity in the economy by providing a haven for deposits that can easily be accessed. This is crucial in enabling transactions, investments, and economic growth. The central bank, acting as a regulatory authority, oversees and influences the monetary system by setting interest rates and ensuring financial stability. However, this symbiosis between banks and borrowers isn't without challenges.
all of these banks over the last several years have accumulated with the deposits that they received, since the president was able to remove all of the reserve requirements during the pandemic to zero. So most of these banks have virtually nothing in the way of currency on hand. And because they would take these deposits that came in from the depositors, and they would buy bonds with them.
Economic factors at play. All right, let's break it down in easy words. When we talk about banks getting serious about taking homes, it's like a recipe with many ingredients. The ingredients? Economic factors that play a part in the whole thing. Consider this. You want to buy a house, but don't have all the cash. So you go to the bank, they give you money, and you promise to pay them back with interest. But here's where it gets interesting. If things aren't going well in the economy, your ability to pay back that money might get shaky. So let's talk about these economic factors. When jobs are scarce and the economy isn't all rosy, people might struggle to repay loans. That's like the dough not rising properly in your recipe. The bank gets worried because they need their money back. They might even consider taking your home if you can't keep up. So, banks will take your home because of this. And what's the this Robert Kiyosaki is talking about? It's all these economic factors and shaky situations we just chatted about. But don't fret just yet. There's a flip side. When the economy is doing well, more people have jobs and things are stable. Your recipe turns out perfectly and you can repay your debt. So remember, it's not just about banks being the bad guys. It's about how the whole economic picture fits together. Impact of debt and leverage. When you need some money, you borrow from the bank. Maybe it's for a house, a car, or starting a business. Now here's the twist. The bank isn't just handing out money for free. They expect you to pay back more than you borrowed, called interest. That's their way of making money. But sometimes things get tricky. Let's say you borrowed a lot, your business didn't do well, or you lost your job. Now you're stuck with the money you borrowed and the interest. This interest just gets bigger and bigger. This is where leverage comes in. It's like using borrowed money to try and make more money. Sounds cool, right? But it's a double-edged sword. If things go well, you can make a lot. But if things go south, you're in a tight spot with debts piling up. Now, let's look at it from the bank's side. Banks also borrow money from people like you who deposit money in them. They use this money to lend to others. But here's the catch. They're using other people's money to make more money. So, if too many people can't repay their loans, the bank's in trouble too. In this context, Robert Kiyosaki says debt is a liability. That means it's like carrying a heavy backpack. Too much debt, and it's hard to move forward. So, whether you're the borrower or the bank, debt and leverage can be tricky. It's like a seesaw. When it's balanced, things are good. But if it tips too much, problems arise.
It's above what they were paying, of course, to the depositors, but in what was typically considered safe places to be, the problem is all of those bonds have an average maturity or an average yield rather of about 2 to 2.5% and long maturities. And so the problem is that since interest rates have risen closer to 5%, every one of those bonds in their portfolio have lost 50% or more of their value. Now, the banking regulations say that they don't have to mark those to market until they sell them. And so they have a whole balance sheet filled with toxic assets that have lost over half their value or more.
Building financial resilience. All right, now let's talk about building a solid financial foundation, something that's like putting strong pillars under a house. Think of it as having an emergency kit, but for your wallet. Life can throw curveballs, like unexpected bills or job changes. So, having some savings tucked away is like having a safety net to catch you. But it's not just about saving money, it's also about making smart choices. When considering borrowing money, ask yourself, is it for something you need? Can you pay it back without stressing out? It's like deciding if you should spend on that fancy dessert. Sure, it's tempting, but is it worth it? This is why Robert Kiyosaki says it's not how much money you make, but how much money you keep. That's like saying it's not about how much cake you can buy, but how much you have left after satisfying your sweet tooth. Alternative perspectives. You know that saying, there are two sides to every coin? That applies here too, especially when we're talking about Robert Kiyosaki's warning about banks taking homes. Kiyosaki's words grabbed our attention, but let's explore some alternative viewpoints. One thing is certain, banks don't randomly show up at your doorstep to take your home. There are rules and processes in place to protect both parties. Speaking of problems, let's talk about the increasing difficulties of obtaining homeowners insurance, especially in the context of natural disasters and climate change. As the world grapples with more frequent and severe weather events, insurance companies are reevaluating the risks associated with insuring properties prone to these disasters. Imagine owning a beautiful home in an area susceptible to hurricanes, wildfires, or flooding. While once these properties might have been easily insured, the changing climate landscape has forced insurers to tighten their criteria. This means that getting coverage for your cherished property can become a daunting task. Insurance companies are now factoring in the potential for more frequent and severe natural disasters, which, unfortunately, might put your dream home in a high-risk category. This shift in the insurance landscape is not only affecting homeowners, but also has a ripple effect on the housing market and financial institutions. Robert Kiyosaki's perspective on liabilities gains significance here. Borrowing too much without a solid plan to pay it back can lead to trouble. It's like biting off more cake than you can chew. It might taste great at first, but then you realize it's overwhelming.
Dave Ramsey, who's a friend of mine, he says, live debt-free. And for 95% of the population, debt-free is a good idea because you don't know anything about money. But if you have a financial education, like my rich dad taught me, which is rich dad, poor dad there, debt is money.
Empowering homeowners. As a homeowner, you can be in control and make smart moves for your financial situation. First off, owning a home is a big deal. It's like having a stronghold that's all yours. But it's not just about having a place to sleep. It's an investment too. Your home's value can go up over time, and that's like seeing your treasure grow. Now, about that worry of banks taking your home. Let's set the record straight. Banks want you to succeed. They're not in the business of owning homes. They're in the business of helping you buy them. If you're facing tough times, they would often prefer to work with you to find a solution rather than swooping in to take your castle. But here's where you play a big role. Being financially savvy is like having a shield to protect your castle. Understanding your mortgage terms, making timely payments, and having an emergency fund can make a huge difference. It's like having guards at the gates to keep troubles away. Robert Kiyosaki's warning might be a nudge to take charge of your financial kingdom. He's like that wise advisor who reminds you to build strong walls and have a plan for any storms that might come your way. Remember, your home is more than just walls and a roof. It's part of your financial puzzle. Key takeaways. Now, some solutions for this can guide us through even the toughest situations. Let's distill these lessons into actionable takeaways that empower us to navigate the financial landscape with confidence and resilience. Economic factors and banks. When the economy gets shaky, it's vital to have a safety net in place. Prioritize building an emergency fund that covers several months' worth of expenses. This cushion can act as a buffer in case of unexpected job loss or economic downturns. Additionally, cultivating a diverse skill set makes you more adaptable in changing economic landscapes, ensuring you remain employable even in uncertain times. Debt and leverage. Leverage can be a powerful tool, but must be used judiciously. Before taking on debt, 1. Assess your ability to repay and the potential returns on your investment. 2. Consider setting up an effective budget, prioritizing debt repayment and living within your means. 3. Seek financial education. Understanding the true implications of leverage empowers you to make informed decisions and avoid the pitfalls of excessive debt. Building financial resilience. Establishing a solid financial foundation requires a two-pronged approach. First, build an emergency fund that covers unexpected expenses. This can prevent you from falling into the debt trap in times of crisis. Second, diversify your investments. Distribute your funds across various assets, such as stocks, bonds, and real estate, to reduce risk and create a balanced portfolio that can weather market fluctuations. Alternative perspectives. Robert Kiyosaki's caution serves as a reminder to tread cautiously, but it's also an invitation to empower ourselves. Take charge of your financial education. Learn about the terms of loans, understand the potential risks, and create contingency plans for worst-case scenarios. Engage in open dialogues with financial advisors, and always be willing to explore multiple viewpoints before making significant financial decisions. Empowering homeowners. As a homeowner, communication with your lender is key. If you're facing financial difficulties, contact your bank to discuss potential solutions like refinancing or modified payment plans. Utilize resources provided by government agencies and nonprofit organizations that offer guidance for homeowners in distress. Educate yourself about your rights and options to ensure you can take proactive steps to protect your home. By cultivating financial literacy, making informed decisions, and seeking professional advice when needed, we can confidently navigate the complexities of economic ups and downs. I hope you liked this video, so don't forget to share it with your friends. And if you want to learn more about debt and liabilities, the next video is for you. Also, comment if you are confused to ask anything, and don't forget to subscribe to my channel.